Hey, good morning, everybody. Welcome to the New Breed of Business. We are here to discuss a Christian perspective on things economic. And today is a discussion about crypto. Crypto is going to the moon. A lot of people are excited about it. It wasn't not a few short years ago where crypto was totally busted when FTX failed. We've had a series of discussions along these lines. Let's get into it. Let's talk more. Joined today by other members and fellow travelers here in the new breed. And so, what we really want to do is always look to what God is saying about economic structures and come into reformation, back into what the scriptures say is true. In preparing for this, one of the scriptures that was highlighted, or in fact, it's a series of scriptures, are in Proverbs about is it wise to gain wealth quickly? And what happens if you do? And what are people's motivations? So, in general, one of the things that caught my eyes is Bitcoin Treasury Companies. Has anyone heard about these things?
Yeah,
Not
we've
about
heard about
treasury
them.
companies. No, Bitcoin, lots.
Right. So people heard about Bitcoin, but Bitcoin Treasury Companies is a new phenomenon. And it reminds me a little bit of the blank check companies, which were also called SPACs, which were hot for a while. People were speculating on the SPACs and buying companies that had nothing inside of them. They were buying these entities that would raise money and then go look for some hot prospects to do a merger or acquisition with. And the reason I mentioned that is because okay, let's define Bitcoin Treasury. In the write-up, by the way, we have good articles you can read in detail about what this is, what is going on here. So, do you remember how Elon Musk decided that he was going to buy some Bitcoin into, I think it was Tesla? It could have been SpaceX, but I'm pretty sure it was Tesla, and that I think it was Tesla.
I think you're right. It was Tesla.
They were gonna buy a bunch of Bitcoin because he was a believer in crypto. And the idea was they also were wanting to sell their cars using crypto. Like, so that was part of their strategy was like, hey, we're going to add value here. We're going to hold Bitcoin. We're also going to accept Bitcoin. And, perhaps some of the thinking there was like, we'll be a bit of a Bitcoin bank. And that's what treasury implies. So every company has a treasurer and a treasury in terms of their what the liquid assets that they hold. So oftentimes treasurers have to look at the cash position, make sure there's enough cash to cover things. In publicly traded companies, commercial paper is often used. That's a short-term borrowing instrument to make sure you have enough cash on hand. These are all treasury activities. So a Bitcoin treasury is, hey, we not only have cash, we have crypto. So think about that. It's like instead of just the normal treasury activities being in cash, now we have a basket of Bitcoin, and that's part of our liquid assets, is sort of how it thinks. Now, one of the issues with that, and which is what we're going to get into today in the discussion, is the Bitcoin is wildly volatile. I didn't get, but maybe I can add to the write-up later some of the volatility numbers behind how up and down Bitcoin goes, but it goes way up and way down. So it has a huge swing, as all crypto does. And we're going to kind of debunk and get into why do these cryptocurrencies have such wild swings? Why are they like incredibly expensive one day? Like now, I think Bitcoin's worth like 111, 10 or $120,000 per Bitcoin. It was once
Wow.
just cents on the dollar. Anybody got that current value?
I got to, if you could go back, Greg, just and explain, I mean, this Bitcoin with its fixed amount of coins and how they trade, and that's what makes it go up and down. I mean, I never quite understood that, having X amount of Bitcoins and can never have any more, never can have any less.
Yeah, great. Let's do that. And in fact, again, in the write-up, you can link to previous discussions where we get into that further. But just quickly, Bitcoin has a fixed supply of Bitcoins. What that means is it's artificially fixed by the guy who, there's an anonymous guy, I'm blanking on his name right now, but it's like a Japanese sounding name, who created the Bitcoin idea. And he propagated it as software. So essentially, it's a notion and it's some code, and this code can be replicated on various computers around the world. And the notion of it is, let's just simplify it. There's a million Bitcoins. There will never be any more than a million Bitcoins. Why are there a million Bitcoins? It was just some guy's idea. Like, let's just fix it at that. Whether he had the knowledge then of what that would do, what it effectively has created is, because it's an artificially restrained demand, as supply goes up for a variety of reasons, the only thing that can go up that's elastic, in using economic terms, is the price. So because it's artificially fixed, if more people want in, the price will go up. And because then people will deal in smaller amounts of Bitcoin to get the same result. So now you don't just work with one Bitcoin, you work with fractions of a Bitcoin. So if the Bitcoin's now $110,000, people are trading in, say, $1,000 increments. Well, that's like a hundredth of a Bitcoin. Okay, so essentially the reason the price gets crazy up and down are I've listed this in the write-up. What are the primary drivers of crypto? Uh, so what I wrote down here, and people can agree or disagree with this, it's just my synopsis of how I understand it. And my background, by the way, is a Wall Street background. I've seen almost every type of financial instrument traded from different perspectives. So some of that experience informs some of these ideas. So I listed here, and people may have other ideas, but I think the three primary drivers behind what drives crypto up and down, and also has the wild swings, are fear, greed, and scarcity. Fear, greed, and scarcity. Okay, well, what's the fear? The fear is, if the bottom is falling out of crypto as it did 2 years ago with the FTX failure, I better sell my crypto before it's worth nothing. I better get out now. And other people might say, no, no, I'm going to hold for the long term. But in speculative markets, when people are trying to profit from the price going higher and higher, um, there's fear and greed always at work. One of the big greed factors, which is maybe more widespread, is when you hear that your neighbor made a fortune on Bitcoin, you're like, well, how do I get that? How do I get a piece of that action? The fear of missing out. I fear that I will miss out on the next Bitcoin. Wait a minute, there's another coin coming that I could make that kind of profit that I missed out on. I want in on that. So Ethereum, for example, the second most traded and highest market cap of crypto, was like the next one that became popularized, that had this incredible run in terms of how much money people made who got in early. And so, because there's low barriers to entry in the crypto world, you can create another currency, and everyone has tried, to be the next Bitcoin. And why would people buy it? Because they're gonna get rich. And then many people, like when in a down cycle, get busted. It's like, well, I was betting that this and that and the other new crypto was going to be worth something, and then it fell out of favor. It's not worth much anymore. So a classic kind of mockery of this greed was when, I think it was Elon Musk, just came up with this idea. Let's make another crypto. We'll call it the Dogecoin, and had the dog and all that. But people like got on board and thought it was great, and so it went up. And the whole thing was done almost like as a joke, mocking like how this a lot of crypto has accelerated in value artificially. And so that's the other thing that's baked into all this, is there's no intrinsic value underneath any of the cryptos. So it's just, it's technology. It's whatever people are willing to pay. So in a sense, once it becomes in a trading environment, it's pure speculation as to what the value is. The value of crypto becomes whatever the next guy is willing to pay for it. So this classically in any financial market always ends up in the boom bust cycle of things. Um, and what's different about crypto, unlike a lot of other um, things that are traded, is because there's nothing underneath it, it does not have any fallback. So if you have a commodity, gold, silver, copper, it's worth what it's worth in a lot of ways because of its use. You can actually use those metals to do things. So you can make piping and plumbing or chips and circuitry. You can do a lot of things with it. And then plus we know biblically gold and silver are mentioned by God. He created it. He put it in the ground. But people can always go see if there's some more gold in the ground and then can mine that and you can have more. So there's underlying value. You might think, well, what's the value of just a metal? There's something there. Now, crypto is just it's just air. It's like software and it's like whatever people think it's worth. There's nothing there. You can't go dig some more of it up. So say a company, right? A company has an enterprise of employees and suppliers, and they're making a product, selling a service. You're adding value. There's something to that, right? So when that company's working, it has real value. Like sometimes the value could be just whatever the balance sheet is, which is like, how much the assets are more than the debts. But in any event, there's something there, right? Like people don't just create a company, except for the blank check companies, and say, "Hey, there's nothing here, but you should buy it." Um, and so when you look at bonds, right? Bonds are worth whatever the issuing company or entity, if it's a government, have in their own coffers to be able to back up what they're doing. But nobody in crypto backs up what they're doing per se. And stable coin's a different matter. Stablecoin is something that's tied to the US dollar. So that's almost a separate discussion. But pure crypto, like a Bitcoin, is fixed supply, nothing's underneath it. It has some really interesting aspects technologically. It's separate from the financial system. So those things are interesting, but it's almost like it's supercharged with the pure speculation of what is it truly worth. It reminds me of another speculation historically, which you might have read about, heard about, called the tulip mania. Everybody was just getting crazy about, wow, tulips are this amazing thing new to Europe. And if we could just corner the market on tulips, we're all going to get rich. And people were paying, like I saw some of these people were for like a tulip, people were paying like 2 shiploads worth of wheat. It's like, really? Or 10 years worth of labor of like skilled labor is one tulip. Or and some of that comes into like, oh, it's a special tulip, it has this coloring and this and that. But people can get excited about almost anything, especially if they think they're going to get rich. So one of the I guess the way of saying this is one of the downsides to all of crypto as it's set up is that it's speculation. Like it's worth what people think it's worth, and if today that's $1 million and tomorrow it's zero, well, that's all it's worth. And you're always going to have that risk to do with crypto. So if there's other solutions, you could use the blockchain technology, the distributed server technology behind Bitcoin and other speculative instruments, and you could tie that to other things. You could tie it to gold. Some people do that. You could tie it to food. You could tie it to a value. We even talk about it in terms of the community working together. Your local community can create a currency and tie it to things that are actually physically present or valuable, like whatever people need. Again, food, energies, metals, whatever the need is. You can tie the digital to that. But crypto classically is everyone's so excited about it because of how much it can go up. And just to come circle back to what is a Bitcoin Treasury Company, what is a crypto treasury company? It's companies that are claiming they can do more when they own the crypto instead of anyone else owning the crypto. Meaning, if I'm a Bitcoin treasury company, I buy a bunch of Bitcoin and then I lend it out, I borrow against it, I lever it up. So it's in a lot of ways, it's a lot of gimmickry around if I have Bitcoin, I can add strategic value to it. So you should actually buy shares of my Bitcoin treasury company because they're going to go up even faster than Bitcoin will go up. And so if you understand that, that's a leveraged play. If you borrow money to buy anything and it goes up, you're going to make even more because you weren't using your money, you were using someone else's, right? And so a Bitcoin treasury company, part of what they're doing is they're trying to juice their returns by using the Bitcoin in various ways that they maybe are uniquely qualified because they maybe have more Bitcoin than others might have. They have a liquidity. Hey, we have a lot of Bitcoin in treasury, so if you ever can't get some, we have some. And so the my net my net conclusion of Bitcoin treasury companies is there's not a lot of substance to them. It's a little bit of gamery and gimmickry, but people are going for it. And this is what's crazy is like people are buying meme coins. The Trump family sold these meme coins that had to do with Donald Trump and Melania Trump. And people went nuts and bought them. Like, is it worth anything? Like, well, it's the eye of the beholder. It's a tulip. So this is part of what's going on. So one of the articles I have in here is that World Liberty Financial, which is one of Donald Trump's crypto projects, they announced we are going to have a crypto treasury company. So they're jumping in. Hey, if people are, wanting to buy, we could create it with our brand and sell it, and then people will buy that and we'll get rich. And I think that's what drives a lot of the crypto market is the dream and the desire to get rich. The dream and the desire to make a quick turnaround of how can I get some money quickly. And that's a classic trading, buying and selling issue. But the supercharging of it is there's low barriers to entry and there's nothing behind the crypto itself. So you could just keep repeating this as long as people want to buy it. And there was a
Question.
book. Go ahead. Go ahead, Deb.
It's interesting. You know, I look at it as all speculation, but people want to buy and sell with this. And for instance, the Tesla deal, Tesla says, well, we'll let you buy a car with Bitcoins. How do they determine, that I go in to buy a Tesla today at $50,000 and I have a Bitcoin that's changing almost every second in value? How do they determine that?
They determine it by just locking in. What they'll do is they'll hedge the Bitcoin, which is one of the reasons you have it in your treasury. Um, as soon as a person buys the car. So let's say it's $110,000 right now. Let's sign the line for Tesla. By the way, Tesla backed away from that. I don't think they're actually taking Bitcoin
Ah,
at the
okay.
moment
I thought they were.
to buy the cars. But the idea would be, okay, it's 110 right now. Let's lock it in. If you sign this and you provide me the monies, I'm going to then go buy financial instruments that lock in that price. Or you could literally, if you're quick enough, take the Bitcoin and convert it into US dollars right away. So that's how they do it. And okay, so then you might ask, well, how do you convert Bitcoin into money? Well, you have to sell it to somebody who's willing to give you money for it. Those are the exchanges. So crypto exchanges allow you to do that. But what the reason that stablecoin got created is because you can even more quickly than converting it into the US dollar banking system money, you can convert it into money like that, but that's crypto. So the crypto that is stablecoin is like US dollar denominated and it shouldn't change value. It should be $1 is $1. It's kind of like the money market is always $1 and then they pay you interest. So stablecoin allows you to even quicker change a Bitcoin into US dollars, but it's still all digital. It's still all outside of the system. But that creates then a risk to the system, and you have to have an interaction to the actual system, and that's the whole stablecoin world. And stablecoin had new legislation that was passed after President Trump was elected. You may have seen that the Senate and the House passed a bill giving stablecoin, I think, some more regulatory freedom. So, does that make sense? Joel, you had your hand up, so I wanted to come back to you.
There's also something that's linked to Bitcoin specifically, is that there is a fee to transfer Bitcoin, generally speaking, from like one owner's hand to another. And it used to be pretty minuscule, but it was a set number of Bitcoin. And so when the value of Bitcoin went up, the cost to exchange Bitcoin went up dramatically, where it's like, oh, cool, I just made $300 when Bitcoin's cost went up. Oh no, it's going to cost me $500 to exchange my Bitcoin. And so it's similar now, right? If you have um, a Bitcoin holding company, um, or also like why a lot of new currencies came about is like, oh, we can deal with that. Like we can make it not as costly, because our value is low for one. But also then you have things um, like how you can purchase gold or silver, right? I can be a part of a holding group where we put together, you know, $300 a month, and there's 10 of us, so we get an ounce of gold a month. That's very rough. We get an ounce of gold a month, and rather than having to pay those basically forging fees of what it costs to create a gold bar, individually, right? We're sharing that fee, and having it all located in one space where we own a portion of it on paper. And so that's like another attribute that some of these companies and newer currencies like have brought to the table, which
Are you
is just
talking about the
like worth
exchanges
noting.
now or crypto treasury companies?
Both. So if you have a crypto treasury company and you are trying to make in-house exchanges of currency, there's ways in which, and it's similar with some of the exchanges, but even with these treasury companies, what that means is, okay, this treasury has X amount of Bitcoin. I am a partial owner of that Bitcoin because of whatever I've invested into it. And because of that, when there are, say, I have another person in this holding company that I want to exchange Bitcoin to, it doesn't cost me a substantial amount to exchange Bitcoin to that person because it's actually just being held by this treasury company, as opposed to I have to have it in a separate digital wallet and transfer it to another digital wallet with like a tracked interaction. It's actually somebody has it in one sole digital wallet and makes a, a markation on paper that now this person owns this percentage of what we have, as opposed to there is an actual exchange.
Right. So I think what you're pointing out is because of the practical limitations of digital wallets, some of these companies are acting like an exchange where it's a paper trade instead of it being a actual trade. So,
Yeah.
hey, in my account, I want to buy Ethereum with my Bitcoin. okay, Treasury Company, or you did some exchange too, but the exchange deals with wallets. I want to make this transfer, and they will do whatever they do on their side. And if they don't actually trade that or hedge it or have something to back it up, when they make the paper trade and say, okay, Joel's account, we're just going to change this to that. If they don't actually back that up by trading the actual crypto, they then have a basis risk, which is the risk where you always have between what you actually are selling to somebody. You're selling a service like here, I'm going to trade Bitcoin for Ethereum. And your basis risk is, well, if I actually didn't move in my treasury those physical assets or have them, then I am liable. I have to make sure that I can back this trade. Of course, when you do all that, you're dealing with what's known as entity risk or credit risk. So one of the things that's a very big downside to that strategy that Joel's talking about is now if the company you're dealing with goes out of business, you're out of business because it's all a paper-based IOU kind of idea. If you don't physically have it in your physical digital wallet, it's all sort of an IOU kind of idea. But it can create efficiencies and it can lower the fees. And I think that's what Joel's bringing out. But what you're doing is you're taking on credit risk. So is that a good trade? You have to take a look at that and evaluate it. But yeah, that's a
Another
good
question.
good point.
Another
Yeah.
question. Um, as your brother does, he mines Bitcoins. And apparently there are companies that have spent tens of millions of dollars building data centers to mine cryptcoins. And I've never quite understood that since there's a fixed amount of Bitcoins. How do you mine them?
Yeah.
That's
So
a
let's get
great question. Thanks.
yeah. So let's talk about the mining. What is mining anyway? Joel, in fact, used another terminology which was new to me. Forging fees. Let's make some gold bars out of like the crypto. We're going to create crypto bars. So these are like ways of describing something that people already know about. So, okay, mining. Well, okay, if crypto's like gold, I can go and we have gold, we can get more gold if we go have a mine or buy a mine or have access to a mine where they're digging up the gold, and as they get gold, we gain more gold. So mining, the terminology is like an analogy to let people think or understand it that way, which is, hey, we're going to make some more. Now, the thing is, though, no one knows how much gold is on the earth. It's pretty rare, but people are finding gold all the time, right? They're mining it all the time. So there's kind of an unknown supply. Well, Bitcoin or any of the crypto have a fixed supply. So what is done is they have an artificial allocation release strategy that releases more of the original set of Bitcoin. So I use that general example. If we have a million Bitcoin, that we started with a portion of the million. Some of it was left for later. So let's say we started with half. So when we started Bitcoin, let's say we started with 500,000 coins. Well, the mining process is how do we get released out of that treasury, to use more terminology? How do we get some of that Bitcoin, that fixed supply that we just made up out of nothing? Well, we actually made some rules and said you could only have half of it right now and we'll release more of it later by an algorithm. And the algorithm uses what is the same kind of mathematics as half-lives are in radioactive materials. So, in other words, if you have 500,000 that's out there trading and another 500,000 to come, if you release half each time of what remains, you keep releasing smaller and smaller and smaller amounts. And you can do that forever, right? So again, this is all kind of mathematics and a fixed supply. You release the amount that is left, some portion of it, and then it's always a portion every time. So as Bitcoin has expanded and the price, and then by the way, what does this do? It drives the price up. So people when they're mining, so that's the math behind how do you get more Bitcoin in and how do people get a hold of it? Well, They only release the new Bitcoin out of the original fixed pie to those people who are contributing to the computation of the blockchain. So miners are literally recording the calculations when somebody does a Bitcoin transaction. Like Joel was saying, if I move my Bitcoin from this digital wallet to another guy's digital wallet, that has to be recorded on the ledger of accounting. And that ledger of accounting is called the blockchain. So think of it as a record of everything that's ever happened with any given Bitcoin or any given fraction of a Bitcoin. Well, the way that that record gets propagated around the world in a decentralized fashion is that people are using computing power to do the calculation and to make the record. And my understanding of it is it's kind of a collision theory. We don't need to go into the details of this, but essentially everyone's competing to get that next Bitcoin. And the first person who solves the equation gets it, everyone else doesn't. So inherently, what one of the issues we've got is that that's very inefficient, but that's how mining works. It's like people having a computer dedicated to the calculation that when Joel traded his Bitcoin from his wallet to another person's wallet, somebody had to record the transaction. Well, everyone in the world is racing to who can make that calculation quickest and post it. And they're the ones who get that little bit more of Bitcoin that's released out of the half of the half of the half of the half of what remains. So, one of the things that a lot of this reveals is there's a lot of layers of complexity. Not many people understand it fully. All they know is, hey, I can get rich if I buy some of this stuff cheap. And so that's actually what's happening when you mine a Bitcoin. Does that make sense? So people are racing to solve the computational problem of creating the new transaction record that recorded somebody moving one Bitcoin from here to there, a transaction. That's what the
So,
mining is.
something that's also worth noting is that's very specific to Bitcoin. But different types of currencies have like different modes of doing that. Um, you know, for Bitcoin, you have to have basically massive processing computer power to do that work. Whereas with something like Tron, for example, what they do is you basically have satellites that you can hook up to your house that triangulate like 5G interactions. You know how um, there's different generations of using cellular devices. So like you'll have a satellite on your house that tracks 5G interactions between people. And by tracking and triangulating those, you get attributed, a portion of whatever. Um, and so I think even with there's another one out there that does like GPS tracking where it triangulates data. Like it basically is people logging GPS movement data. Um, and rather than Google just collecting that information for free, um, it's like you get paid with a portion of whatever this finite amount of this crypto is. So there's very different ways that they're mined, but generally it really is this process of like, all right, we decide this kind of mode of access based on this half-life algorithm, and you know whoever gets it, you'll get a portion of it.
Right. I think what Joel's pointing out, so people understand it, is the Bitcoin example is literally related to the work it requires to create the transaction record. But other companies will use a crypto they created to pay people for work done, computational work done. So what I think you're saying, Joel, is that, hey, if you do all of this work for GPS tracking, if you do all this work for data gathering in tracking this or that, we'll pay you in terms of this crypto. So it's the idea of work for the crypto. So the crypto's not inherently worth anything. It's only worth what people pay, but we'll pay you for the work. So then this creates the notion of like, well, actually, it's worth what the work is worth. And that's one of the ways that crypto tries to create value is if everyone thinks it's worth something, we can actually pay people to do work with it. As an aside, one of the things that Microsoft, and this is probably in a whole nother discussion, Microsoft filed for patents in some of the technology of work for money, work for crypto, work for digital value. And that's one of the issues of where is speculation as to, well, where is this all heading? Are we all going to have to work to eat to get our crypto, to work for somebody who, by these rules, to get this or that currency? That starts to sound like a control mechanism and a way of getting people to work for you for the digital money. So that's another whole discussion. But Joel's pointing out, hey, look, there's another model, and I'm not familiar with Tron, but maybe Tron is one of those that has this model. I think one of the other things is that if you're just like for the storehouse, we've talked about, let's create the idea of a currency that's backed by the community and value in the community, but it can be digitalized. It can be creating of a transaction record. So there's way more efficient ways of creating a distributed um, transaction record digitally than the collision theory of how Bitcoin miners create it. So tons of energy, computing power, costing lots of money and lots of resources, actual natural resources, is used when you do it in the Bitcoin style. It's very inefficient. And you may have heard of like server farms in China where they're like have a nuclear power plant just making, enough energy, cheap energy to mine the Bitcoin. Um, so if you use the technology and you want to create your own currency that's not based on just pure speculation, but it's more just efficiency, distributed records, accounting for people using it, you can do that in a much more efficient way. You don't have to get so. The reason that people pay for all that electricity is because of the desire to make money on the coin going up. That's why they do it. That's why my brother does it, because he wants the coin to go up, as
Well,
everyone does who's got the coin.
well, it's interesting what Kent is doing. That's Greg's brother. Um, he's got one computer and he's got it set up so that it mines for him automatically. He doesn't have to pay any attention to it. And the way he explained it to me, it uses about $10 worth of electricity a month, and he ends up making $1. So
Right.
at the end of the month, he makes $5 above and beyond his electric costs.
Right. And that doesn't include other costs like the air conditioning to run. That doesn't include the other
Well,
costs.
I think in his case he does because he's got one computer and a milk case with the rest of some electronic equipment, and he's got it in his basement. So,
Right. So it's what he's doing. He's making a variable cost decision. Back in the old days, he would create these computers to do it because you got a lot more value from it. Today, it's very hard to do that because people have taken this to an extreme. And that's why something like before the current administration, it was some crazy stat of like 90% of Bitcoin is being mined in China where the electricity is cheap. It's kind of like if you go to Venezuela, gas is cheap, but that doesn't mean you want to be there. Um, so some of these things are really artificial. And if you included like in Kent's calculus, let's just say the $10, $1, the replacement cost for those electronics. So if something fried in his computer, he'd have to recreate that or buy
yes,
new
yeah,
parts or whatever. If you actually factor that all in, he's probably losing money. So
probably
this
that's
is
true.
one of the problems is that it sounds great until you sort of realize where it's all headed.
Well, and as Joel was saying, he also on top of his little basement operation, he also does the triangulation. Like I have a transmitter in my house, and Miles has one, I think, in California, where they absorb the people, within like a mile radius, all of their transactions.
Right. So that's maybe
But it
what,
still only adds up to $1 out of 11.
right. So what I guess the point to take home here is that crypto is very interesting for certain reasons. Like it's again separate from the financial system, it's digital, it's portable, it's distributed, so like you can get the record in multiple places. It's not centralized or controlled in that sense. Those are all positives. But the thing that really drives it is the tulip factor. I'm just telling you, that is
Yeah.
what drives all of crypto. And it's the greed, desire for these things to go up. And if we just create a new one with a new angle and a new approach, we will get rich. We will profit greatly. We will really make out well. And so then what so I've met a lot of people who have Christian crypto, for example. And many of those solutions have the same tulip built in. And it's like, well, if it's Christian and the idea is to help people and trade within a community, why is it speculative and that the first people in get the most money? That's like a pyramid sales scheme. It's like, hey, if I've got this greatest, the pill that cures cancer, and I'm the first one in, and I'm going to get everyone into my downline, I get rich. The next guys get a little less rich. The guys in the bottom are the ones who are churning out the whole engine for this thing, and they get the least of all. So I would argue that's not really kind of a Christian ideal. It's more of a back into just speculation and greed. So I think, we always advocate in the storehouse is like if a community creates a storehouse and they would like to have a digital currency, what shouldn't be built into it is that speculative portion. What should be built into it is like, hey, things in our community that add value, that should be behind the currency. So people don't try to game the system just for gain, just for profit.
I,
Very
I,
similar to the scriptures that talk about like don't try to take advantage of people at the bottom and profit from them. Instead, try to help them. Go ahead, Deb.
one thing that I think is also involved in this whole cryptocurrency thing is people, criminal elements, large or small, like it because they can, move money, trade money, do deals, and it doesn't have any record, at least that they think can be traced.
Right. It's more anonymous and it's harder to track.
Now, I don't
Although,
know what percentage of the crypto transactions that includes, but it's probably a fairly substantial amount.
yeah, that's always been a part of cryptocurrency is that downside or dark side. If you have these advantages and you can sort of hide from governments or do things outside of the eyes of others, what will go on there? All sorts of things will go on there. So for sure, that's another.
That was the major kind of play for Silk Road, which is kind of like it's kind of the quintessential dark web buy anything you could think of space. Um, and like
Including
the
credit cards,
majority
stolen credit card numbers and things like that.
stolen credit card numbers, hitmen, human beings, like you could buy whatever. And the majority of those transactions were done using Bitcoin when Bitcoin was, you know, only worth like $60 for a Bitcoin.
Yeah.
Um, yeah,
Yeah. So that's part of the history of Bitcoin. Because Silk Road was able to operate outside the eyes of any banking regulators. And so they were able to do that. And that's one of the upsides, downsides to it is no one's regulating it. And if no one's regulating it, That could be a positive if you have a controlling government that wants to persecute you and kill you, like maybe China and Russia. But the negative is if you have a government that's actually law, trying to create good law and structure, and then criminals are able to use that, that's not good. So for sure, that's a factor in all this. So I think it's just interesting because right now the crypto is very much in favor from a political standpoint because President Trump was elected. He really has been an advocate for cryptocurrency. He saw it as an opportunity to create his own cryptocurrency inside of his family businesses. He got on board with a lot of people who are like pro crypto, politically, who helped, fund the campaign and all that. So we're in a very favorable season right now, and it's not unexpected that all these cryptocurrencies are going higher and higher and higher. And if something is going higher and higher and higher, one of the oldest tricks in the book is again leverage it, borrow money, buy it. Let's buy some Bitcoin. It'll go from 110 to 150,000. And because we borrowed half of the money and only used half of our own, instead of getting a 40% return, we get an 80% return. Do you see how that is? So this is one of the things like as the speculation takes off through political favor, people see like a really nice ramp that they can bet with. And people are doing that all the time. Now, what's interesting, and this is always a warning, is that there are people on the other side of that bet who are betting that it's going to go down at some point. It's so volatile that it inevitably will. And so there's a lot of shorts on the hedge fund side of things that are closely scrutinizing these Bitcoin Treasury companies and other such vehicles, as well as a whole lot of other speculative cryptocurrency. And they're looking to how do we short this? Because inevitably it's going to get hit and go down is the idea of that. Again, it's for greed. It's for like, well, we're going to get rich when all these fools like take a dive. That's kind of, I'm using some language there that's very provocative, but that's a little bit of this fear and greed dynamic of a speculative, highly volatile anything that trades. And again, there's nothing backing it. So, like in classic cases where you have things go up and down in value, if it ever, busts, you can maybe extract some value in whatever is left. That's what bankruptcy proceedings do. If a government has the ability to tax, they can tax people to get more revenue to be able to pay you back. If it, if if you're dealing with money or bonds, if it's the government, you're dealing with the government's credit rating. So if you're dealing with like futures in gold or copper or something like that, there's always ultimately the value of those metals. And again, it can all of the commodities are like that. There's always some value in food, energy, metals. But in crypto, there's nothing there at the bottom. So that's one of the differences in this when it trades up, down, sideways, and all over. So the largest, I wanted to point out too, the largest Bitcoin Treasury Company that I could discern was a company called Strategy. I put that link in here. You can take a look at it. It's currently worth 112 billion. I have not done the analysis to see how much more that is worth than the actual net Bitcoin they own, but I would venture to guess it is higher than their net asset value. So therefore, they're getting a multiple because everyone thinks this is going up. That's like the whole play. Hey, while things are good, let's get the premium for selling this package of using the Bitcoin or the crypto in multiple ways, and try to capture value. Is that value real? Well, that's in the eye of the beholder. I think the warning is like be careful because these kind of tricks are as old as the book, or as old as markets have been trading. And let's not forget the tulip phenomenon. Anyone else want to bring anything in? So I think people might even be asking, should I be buying into crypto at these levels? Well, pray about it and digest what we're talking about here and consider what some of these alternatives are, which we talked about briefly. And you can read about that in the write-up. Currency is backed by Christian communities. We had a whole discussion with Doug Jaden, who is part of the Storehouse leadership team, talking about currency that's backed by agricultural goods and other things. So there's other ways to solve what crypto actually is a benefit in solving. And some of those materials and resources are there. Anyone want to share or ask a question before we wrap up?
I didn't I, I didn't ever understand it. So you've opened my eyes to a lot of things because I had no earthly clue, honestly, how it all worked.
Well, good. I'm glad to hear that. And hopefully some of this has made sense to people who are watching it. I mean, we want to help educate people because a lot of this is, hey, I hear people are making money off of this and I don't understand it, but I feel like I got to get in. So if you're going to get in, understand it and understand what's going on with it. And then also understand like there are other ways, economically, we as Christians can enter into working together with each other. So let's
What's
consider
the
them.
short thing? What does that mean? What people
Okay.
are
Yeah. So shorting is selling short. If you have a liquid market, people will lend something to someone else who wants to borrow it and sell it. And then when they repay the loan in kind, their idea is I'm going to pay a lot less for that later when I repay my loan. So to take an example practically, the classic short selling you will see is in stock markets, right? So let's say you have 100 shares of IBM, and as holding IBM shares, you want to make a little extra money, which is called a carry, or it's called like a you could think of it as like interest. If you want to earn a little extra money in interest owning your IBM shares, you can lend them through your broker dealer to someone else who wants to borrow shares. Now, you're not taking on any risk when you do that, except for the credit risk of the counterparty. But what you're doing is you're then providing a liquid pool of shares in IBM that could be borrowed by short sellers who will say, thank you very much. I will borrow those 100 shares from you. Let's say it's $100. So at the time they borrowed your 100 shares, IBM was trading at $100. Now you're going to get back 100 shares of IBM. So you don't care if IBM goes to 50, 150, you still have your shares. You made a decision. I want to own for the long haul these shares. But what the speculator does, the short seller does, is through their prime broker, through their broker dealer, they will find pools of stock and pool them together and say, like, let's say they want to not only short sell 100 shares, they want to short sell a lot more. Well, they could take your shares, someone else's shares, and a bunch of people's shares, pool them together, make lending agreements. Okay, here's my agreement. I agree to repay you your 100 shares of IBM in, say, sometime in the future. And then what's on me in holding these shares is what I do in terms of like with them while I've borrowed them. So what a short seller does is they take your shares and they sell them in the open market. So let's say it's at 100, you do the lending agreement, they borrowed your 100 shares, they sold that on the open market. So 100 shares at $100, that's $10,000. So they got $10,000 of proceeds when they did that share borrowing and short selling. Now, what they're going to do is hope that the price goes down. So let's say their idea, their hope is that IBM is going to go from $100 to $50. It will drop half in value. Well, they've already sold the 100 shares for $100,000, sorry, $10,000. What they're hoping for is that in some time in the future, they can buy those shares back at $5,000, to use the example. And if they do, they made $5,000. Woo! We just made money by short selling the stock. So that's how short selling works, if that made sense to you. It's when you sell something when you don't own it. So you borrow it with a promise to repay it in kind later. I'm going to give you your shares back. Trust me. I sell it in the open market right now. That's my short sale. But I have to cover that later, which is called short covering, by buying those shares back. When I buy them back, my hope is that they're less, they're cheaper. The price went down, and then I can buy it for cheap, make the profit of the difference. My risk is if they went from $100 to $200, I'm now going to have to pay $20,000 to repay you back later if the stock went up. So that's where a short seller gets burned or loses money. So that's what short selling is. Mathematically, you could just think of it as adding and subtracting. So I have this. If I'm buying it, I'm accumulating, I'm adding to my share count. If I'm selling it, I'm lowering my share count. Well, what if I have no shares at all? I'm lowering it by the share count of what I borrowed. So it's just sort of if you want to bet on the market going up, you buy the stock and you hold it. If you want to make a bet on the market going down, you can sell your own shares. That's one way of doing it. But if you don't own any, you borrow some and you sell their shares. And then you buy it back later when it's cheaper. That's what short selling is. And it can be done with any financial instrument. So you can short sell crypto as well. You can borrow crypto from someone else, sell it in the open market, hope it drops in value, buy it back later for cheaper. Make the difference.
Isn't the key, Greg, though, that whether you're an investor or a gambler, you have to really believe that that particular stock or whatever is going to drop in value.
Of course. So
Yeah. So
all
I
of
mean,
that is
without that, you
speculation.
wouldn't do it just as,
So there's always speculators in markets. Markets function where buyers meet sellers, and then there's always speculators who jump in and they say, I'm going to speculate that this is going up or down. Some people might buy a company because they want the long-term benefit of those dividends. But as I said, when there's nothing underneath the thing that's being buying or sold, it's almost all speculation. If
Something to add is that's kind of that was the whole. I think a lot of that was made clear to more of the public with the whole GameStop situation, where effectively you had a company that was being intentionally gutted, um, and whoever was aware of this was doing this types of short selling where they would borrow and the stock would drop and drop and drop. But then a bunch of people were just like, actually, I value this company for like what it is and its service. And so I'm going to invest in it because I don't want it to go out of business. And as that happened, GameStop hired a new CEO. This new CEO did, cleaned up the books and got things in order, and the stock kept raising and going back up. But then the issue was is that people that had short sold and borrowed stocks, they couldn't they couldn't buy them. One, because people were now holding this stock because they valued the company, but also they couldn't buy them at this lower rate and actually make money out of the situation because they had borrowed it at a higher rate and it was going up. Um, so you can kind of see how that actually ends up playing out with specific businesses um, historically, but it's it's done across the board. But when you see it with just like one company and how the value of what the actual company is can interact with um, how people engage with the market, it's really interesting to see that contrast.
Right. So what Joel is pointing out is what's called a short squeeze. which is there are a bunch of people shorting the stock, but then when it goes up very quickly, the roaring kitty and all the meme stock buyers, the retail buyers, like were driving demand way up because it was on social media, because they thought there was hidden value. And it was one of those rare cases where by hiring a new manager for the company or CEO, like they actually were able to do some things. They were able to raise some money off of the price going up. So they were able to actually create something that has real value. Now, GameStop has gone way down since then, and it's like that was like a rare example where the market maybe had it wrong in terms of what was valuable still inside of the company. But I guess one of the key points to bring out is when we were having that discussion, and I'm going to link the GameStop discussion that we had at the time this is all going down, is that the Lord was highlighting, like, yes, this is interesting, but don't get distracted. Focus on helping people that I care about. So there was kind of like the David versus Goliath, like, these young um, buyers of the stock and the short sellers, these evil hedge fund guys. It was kind of like described as a David and Goliath situation. But God was saying, like, no, there's greed actually on both sides. Don't get too caught up in what's happening here and picking sides, but instead focus on helping the working poor and those who are in need of financial assistance. This is all part of like the storehouse creation was this dream that I had that in the inner city of Chicago, which represented kind of the economic models of the University of Chicago, there were all these people who were suffering, who needed help, who were the bottom 40%, let's say, economically. And God was saying, instead of focusing on the speculation in the markets, take your resources and put them to work by lending to people who need that and who are being taken advantage of by these other publicly traded companies and banks. You can go help as an evangelistic tool, lend to communities like this that are in need of financing basic things like household goods, cars, housing. And that was kind of the redirect. So it was interesting because even though there's speculation and what we're talking about here in crypto, and there's interesting things that are happening and the meme stocks, like Joel was talking about, God is really saying, like, come out of the speculative bubble of things and come into and enter into my economy. And a fundamental way you can do that as a believer is not just give to a ministry, but lend to the poor. Because this is part of what Jesus taught was, hey, you should lend to people who want to pay you back, but they need a hand up. They need help. And they will pay you back if they work together with me and I will bless them. And they could actually bless you back if they choose to. And it's a different economy. That's the economy of giving and receiving. And it's different than Bitcoin. It's different than GameStop. You can compare and contrast those things. So that's why we're talking about the alternative to crypto is really entering into God's economy in a deeper way, where we as a community, a Christian community, like they're doing right near Diane in the Bradenton, Manatee County area, is let's help people who are in need of help with our what God has supplied us, and let's multiply that by developing people, helping them come out of poverty, helping them come out of debt, and into the greater kingdom work, which is less about individual profiteering and speculation. It's more about community dynamic of sharing in and pooling together resources to help folk. So that's worth mentioning as like an aside to the GameStop phenomena. All right. Anybody else want to share anything? Joel, if you're still there, would you wrap us up in prayer?
Heavenly Father, that your ways are higher than our ways. Thank you that you've given us as humans.
Joel, you there?
They're in spirit.
Is somebody out there? Joel's there. Diane, maybe you could close us in prayer today. That'd be great.
Certainly. Heavenly Father, I just thank you for the wisdom and the knowledge that we gained here today, Lord. I thank you that that even though we've gained this knowledge, Lord, and this wisdom, Father, and it may have equipped us with some things, Lord, that you are our ultimate wisdom and equipper, Father. So, Lord, we just thank you that you give us all that we need, Father, that you are our ultimate provider, Father, that we not look to the ways of this world to provide for us, Lord, but that we look to you for our provision, Father. So, Lord, we just ask for your wisdom and knowledge, Father, to how to go about um, equipping the community, Lord, and the role that you have us to play, Father, that we would not take on a role that isn't ours, Lord, that we would do everything according to your will and your plan, Father. We love you. We thank you. We need you. We praise you and we worship you. In Jesus' mighty name we pray.
Amen. All right. Well, good to be with you guys. Thank you. And till next time, God bless.
God bless.